Equity markets. Ownership in the modern world. John stands at the window of his executive office, looking down at the sprawling factory floor where hundreds of workers are assembling the Stickman Pro keyboards. The business is a success. The bonds he issued are being paid on time, and the world can't get enough of his product. But John has a new vision. He doesn't just want to build keyboards. He wants to build a global tech ecosystem. He wants to develop software, open retail stores in every major city, and perhaps even venture into high-end gaming peripherals. To do this, he needs capital on a scale that bonds simply cannot provide. He has reached the limit of how much debt his business can safely carry. If he borrows any more, the interest payments might crush him during a slow month. John realizes it is time for the ultimate step in a company's evolution. It is time to sell a piece of the company itself. It is time to enter the equity markets. As Brealey, Myers, and Marcus explain, equity represents ownership. When John issues common stock, he isn't taking out a loan that he has to repay. Instead, he is inviting partners to join him in his journey. These partners, the stockholders, provide him with permanent capital. In exchange, they get a claim on the future of the business. But this is a very different relationship than the one John has with his bondholders. To understand the equity market, John has to understand the concept of being a residual claimant. A bondholder is a creditor. They're first in line. If John's business makes $1 million, the bondholder gets their fixed coupon and not a penny more. If the business fails and has to be sold off, the bondholders are paid before anyone else. Shareholders, however, are at the back of the line. They only get what is left over after all the employees, suppliers, tax collectors, and bondholders have been paid. This is the residual. If there is no profit, the shareholders get nothing. There is no legal promise of a dividend. However, the trade-off is the upside. While a bondholder's profit is capped at the interest rate, a shareholder's potential profit is theoretically infinite. If Stickman Keyboards becomes the next global tech giant, the shareholders own that growth. John decides to take his company public. He starts with the primary market. This is where the company itself issues new shares and sells them to investors for the first time. This is often called an initial public offering, or IPO. John works with investment banks to set a price and find buyers. He realizes that by doing this, he is giving up total control. As a majority owner of common stock, he still runs the show, but he now answers to a board of directors. These directors are elected by the shareholders to oversee the management of the firm. Each share of stock typically comes with a vote. John is no longer just a king. He is a leader in a corporate democracy. Once the IPO is over and John has his millions for expansion, the shares start trading in the secondary market. This is what most people think of when they hear the stock market. Places like the New York Stock Exchange or NASDAQ are secondary markets where investors trade shares with each other. When an investor buys a share of Stickman Keyboards on the NYSE, John's company doesn't receive any of that money. The money goes from the buyer to the seller. However, the secondary market is vital for John. It provides liquidity, meaning investors are willing to buy shares in the primary market because they know they can easily sell them later to someone else. It also provides a constant report card on John's performance. If the stock price goes up, the market is telling John they like his strategy. If it falls, they're signaling a lack of confidence. John starts to see his company through the eyes of these new owners. They aren't looking for a steady interest payment. They're looking for two things: dividends and capital gains. Dividends are the cash payments John decides to send back to shareholders out of the company's profits. Capital gains are the increases in the stock price itself as the company becomes more valuable. Together, these make up the total return on the stock. John realizes that his new job isn't just about making great keyboards. It's about maximizing the value of the shares for his partners. The transition is a massive psychological shift for John. With bonds, he was a borrower managing a debt. With equity, he is an owner-manager leading a community of investors. He learns that the equity market is a place where risk is priced every second. It is more volatile than the bond market because the residual is uncertain. If the economy dips, the leftover profit might disappear entirely, causing the stock to crash. But if the economy booms, the stock can double or triple in value. John looks at the ticker symbol for his company scrolling across the bottom of the news screen. He feels a sense of pride. He has invited the world to own a piece of his dream. He is no longer just a guy in a workshop. He is the steward of thousands of people's investments. He understands that the equity market is the engine of the modern world, a place where people with ideas meet people with capital to build things that neither could achieve alone. John takes a deep breath and gets back to work. He has a global empire to build, and he has a whole world of partners watching his every move, waiting for the value of their ownership to grow.